Hello and welcome to this week's edition of Inside Today's Boardrooms from Diligent Institute, your source for the latest and greatest in corporate governance, all in 10 minutes. I'm your host, Lisa Edwards, Executive Chair of Diligent Institute, and today I'm joined by Matt Seto, Principal at Meridian Compensation Partners. Matt, welcome to the show.
Thanks very much for having me today, Lisa.
So this topic is going to be on one that I really love, which is compensation resilience. In the context of the current macroeconomic climate in North America, which is pretty sporty for a lot of companies and boards these days, what should boards be thinking about, and what should those compensation committees be thinking about as they design resilient executive compensation programs? And maybe start with just like a little tiny bit on what is a resilient executive compensation program?
Perfect. Thanks for the question, Lisa. I think when comp committees think about compensation resilience, they really think about programs that withstand the pressures of external macroeconomic events or industry disruption. And so if the company's pay programs are operating effectively, they're able to withstand some of the negative and very positive events in the broader macroeconomic backdrop. And so normally when people think of compensation resilience, they really think of diversification, and really diversification in a number of different lenses. One is through long-term incentives, which represents the majority of executive compensation pay at risk. So the mix between performance share units intended to deliver performance outcomes for investors, restricted share units, which are really in the incentive design to provide retention in down markets, and stock options, which are really there to drive leveraged pay outcomes in rising share price environments. And so we often think of diversification in terms of the mix of vehicles. We also think of diversification in terms of the mix of compensation as a whole. So the delivery of cash versus fixed pay and bonus pay versus long-term incentives, and really coming up with a diverse set of pay components to deliver effective executive compensation. We also think of diversification, Lisa, in the context of the annual bonus plan and the long-term plan in terms of the types of metrics included in plan design. So we think of the combination of a relative market metric like relative total shareholder return and PSUs in concert or combination with an absolute financial metric like ROIC. That has the benefit of designing a resilient program that measures and rewards the management team on execution of the absolute strategic plan when it comes to ROIC, but also provides a calibration to the external environment when you're measuring performance against a relative TSR peer group. And so it's true that diversification does lead to resilience, but there's also some trade-offs of too much diversification. Some critics of well-balanced scorecards and plans say that too many incentive metrics may dilute management focus. So if you have 6 metrics versus revenue and EBITDA, which are the real determinants of value creation for a company, that might dilute management focus. There's also the argument that if you put 6 different metrics in there, everything when you average it out is going to pay around target. And so these are valid arguments, and it really comes down to the compensation philosophy and what the committee values.
Yeah, it's interesting because I think so many of us do this, have these conversations, for example, with financial advisors on, there's a reason to have a mix of bonds and stocks. And it's because, when the stock market is go performing, we all look at those bonds and go like, ugh, that's not that great. But then when it flips the other way, you're pretty grateful for having the alternative vehicle in place. And I guess it's really no different when you think about, a compensation plan. You don't necessarily want to over reward when the market is on fire, but you also don't want to over penalize when, when some of those other incentive vehicles aren't really performing, maybe through no fault of the executive team. So, I think it's a really interesting concept. What are, putting aside for a minute, just this whole notion of, portfolio diversification, compensation portfolio diversification, and just agree that is, just a huge benefit when you're thinking through an incentive plan. If you're on a compensation committee, what are some of the other ways that compensation committees can, ensure that these compensation designs are resilient?
Well, I think it really comes down to goal setting, Lisa. And this is fundamentally one of the biggest responsibilities of a compensation committee working collaboratively with its independent advisor as well as the management team. And this is a lot easier said than done. It's difficult to put in resilient goals in practice because you really have to calibrate with multiple perspectives. But ensuring the definition of target is appropriate and sufficient in the eyes of the board is really critical. Because we really want to make sure that it withstands credibility from an external perspective, from the investor community, the proxy advisors, but also internally, it's credible to the management team so that they know that they can hit those goals in any type of economic backdrop. And so getting that balance right is very challenging. When we talk about targets, we talk about target, and then we talk about the performance shoulders around target. So, as an example, an EBITDA target of $100 million in a year, setting a threshold of minimally acceptable performance at potentially 85 million and the upside at 115. So, hugging around target. When those performance shoulders are set too broad, we tend to see bonuses that closely track in and around target each year. Potentially, when they're set too narrow, you could end up with the outcome of 200% payouts and 0% payouts year over year. And so those both of those outcomes may be less than ideal. And I say may because it really depends on the compensation philosophy of the organization. But that really adds to the whole discussion around design resilience. I have a client, Lisa, in an industry subject to a lot of commodity pricing. So during COVID, due to some uncertainty in target setting, they set a financial return on invested capital goal, but they set it on an improvement basis. That was a really resilient design for COVID. Today, not so much because they're in a steady state environment and they're over indexing on the improvement metric in the last few performance cycles and paying 200% at max. So we've had to reset the program in the context of the current macroeconomic environment to set targets for ROIC based on cost of capital and other external market data sources to calibrate what's an appropriate level of return to investors in that particular business. That's just an example of where years of above max payouts. I know we often think of resilience on the downside of retention, but years in which you've got three above target or above maximum payouts can actually question the credibility and the resilience of program design.
Yeah, COVID is the gift that keeps on giving, I guess. But it really did shine a spotlight on some of those things that break when there's a sort of macroeconomic black swan event, and I think that's probably worth sort of companies thinking about just does this hold up, and under what circumstances would we modify, and I know a lot of companies did do sort of different special awards or different things during COVID because they didn't have that framework in place. And obviously, some of the institutional advisor firms don't love that. But I think it was a big lesson to a lot of companies that things aren't always going to go steady state. And when you get into one of these cycles that things have been going for 8 or 10 years, that it's not necessarily going to go forever, right?
That's exactly right.
So, as you think about the target setting and putting yourself in the shoes of a compensation committee, what are the types of data or analysis that it's important that they understand to design these programs?
I think there's really three that come to mind, Lisa, that I would recommend to test the resilience and incentive targets. And a few are forward looking in time nature, and a few are backward looking. And we used all of these analyses back to my earlier example with the client subject to commodity swings when we were deciding to move from an improvement metric to an absolute target setting. The first is really just to review the history of performance outcomes and pay outcomes over a longer time frame. So normally over a 10-year period, we would expect the management team to hit threshold 8 and 9 years out of 10. So roughly an 80 to 90% probability of achievement. Target 5 to 6 years out of 10. So 50 to 60%, almost a coin flip. And then maximum 10 to 20% of the time. So back to my example, 3 cycles in a row of 200% payouts. That was really leading to challenges from a credibility perspective.
That's when something's wrong.
Exactly. Ideally, you would also layer in potential compensation peer data, so both their performance outcomes over that longer time frame, as well as their pay outcomes. And the reason you layer that in is this an industry phenomenon? Is everyone hitting 200% payouts? Was it just a really strong past few years for that particular industry, or is this company specific? The second analysis would be every February, January committee meeting cycle for calendar year end companies. So Q1 that would just passed is really to assess the stretch and targets on a go forward basis. So assessing them in the context of the strategic budget that was approved to the board, assessing the targets in the context of what's being guided to the street, what analysts on Wall Street are expecting of the business, and also what I like to call risk adjustments to budgets. So if all of the good things happened, here would be our results on the upside. If all of the bad things went wrong, here would be our results on the downside, and calibrating targets appropriately based on that information. And the third and final piece of analysis that many of our clients find really valuable for testing the resilience and compensation design is just a realized or realizable pay for performance analysis. So testing what actually went into the pockets of executives or will go into the pockets of executives over time. And does that link well with both absolute and relative performance over a longer time frame? And really, we're just testing the question, are our programs resilient to all different economic cycles? And does it make sense? And is it aligned with our business strategy?
Great. And I didn't even ask you any questions about should there have been upside and downside caps on Elon Musk's compensation package. So I'll let you off the hook on that one.
That's a topic for another day.
Right, that's a whole hour-long podcast. Is there any before we break any best and final thoughts for our audience as they consider sort of compensation resilience?
Sure. I would just leave you and our listeners with the following. Compensation resilience looks so different for different companies. And I would really encourage companies to think through what are they trying to achieve in compensation resilience and how does it align with their business strategy and compensation philosophy. You may have a committee that wants to see more moderated payouts in program design. And so like the diversification that I talked about at the start, you may get comp committees that really want to focus on one particular metric at the detriment of having a lot of leverage in the program, which could be viewed as a pro, but also a lot of downside risk in low economic environments or weak economic environments. So I would encourage comp committees to really think and evaluate their own compensation philosophy and whether the outcomes of the pay programs that are being driven by the incentive designs underpinning that compensation philosophy are aligned with the expectations of the business.
That's great. And I think, obviously a lot of boards have to articulate that in the proxy these days. And the better you do that, sort of the more clarity you provide there, the better off you probably are. So really good insights. And that is all the time we have for today. Thank you so much, Matt, for chatting with us today. And for more great compensation intel, you can check out Meridian Compensation Partners website and their executive compensation podcast. Thank you for listening, and we'll see you on next week's edition of Inside Today's Boardroom.